Good afternoon, welcome to Market Wrap, number 179, Stuart Williamson here at the helm. This week, interest rates to fall, is there a boom on the horizon? What is the latest local mortgage rate update and Welsh mansion tax? And now, is it a good time to buy? Thanks for watching. This is all about just giving general information out there for our time-shortened clients so we can learn a bit. So, interest rates to fall in 6 months. The UK market boom on the horizon. Is it true? Well, this week, investors acquired a record 93 billion of UK government bonds as investors bet that interest rates had peaked. The sale of 20-year gilts fetched the largest ever level of orders for UK sovereign bonds, excluding the first ever sale of green bonds in 2021, according to Bloomberg. The sale of the bonds, which mature in 2043, was conducted by Barclays, HSBC, Lloyds, Morgan Stanley and UBS. And the race to snap up these bonds comes as investors bet that interest rates will begin to fall next year. The UK CPI, Consumer Price Index, dropped sharply to 4.6% in October from 6.7% the previous month, according to the ONS, after a slowdown in the increasing cost of gas and electricity. As a result, money markets are pricing that the Bank of England will begin cutting interest rates by 1/4 percentage point by June 2024, the latest, with some economists predicting rates will be cut sooner. How about that? What will that mean for our loans? Good news. Basically, when interest rates are high, the yield on bonds, the return for investors, is higher, and vice versa. Global bonds have rallied in recent days as traders ramp up bets that the central banks will begin cutting interest rates next year, with 20-year gilts now yielding around 4.6%, down from a peak of 5% last month. So what's happening in the local market, the current market for mortgages? Well, Halifax has just started offering a sub 5% 5-year loan, which is a cut in rates of 46 basis points. Their intermediaries will offer a sub 5% 5-year home loan with rates starting at 4.53% as of yesterday. The lender's broker only arm says its home buyer deals include first time, new build, large loans and affordable housing, shared equity, shared ownership and equivalent green products. It has reduced its deals back to 46 basis points. That also goes on to cover 2-year deals as well. The 5-year highlights are 60% loan to value at 4.53%, 5-year loan to value up to 75% at 4.63%, 5-year loans up to 75% at 4.64% with no fee and a reduction of 20 basis points. All the others are £999 fees. Sorry about that. 2-year highlights include loans at 60% loan to value at 4.97%, 2-year loans between 90% and 95% at 5.85%. Both of those got £999 fee. 2-year loans up to 60% at 5.23 with no fee. This is on the back of last week's changes when Santander came in and did a similar sort of thing. Now, the networking event we had at the British Club this last week in Singapore is a major topic, as well as planning for university fees. Here's a short video of what we did on that night. It's just a relaxed evening, it's just networking. Why not try and come along to the next one? The next ones are in Dubai in the new year, Abu Dhabi, then on to, I think, Riyadh, then over to the Far East. It's about who are APW, and basically we're just a broker. So we go out and find property for clients all over the world. We've been doing it for quite a long time, as you can see, 35 years. We have about 11,000 live clients at the moment, and last year we invested about £133 million.
Capricorn itself is London's largest independent brokerage. We're a whole of market. We've been doing this job for 25 years now. We are the go-to guys. We'll go to and try and source any type of property finance you need.
We are independent UK university advisors and career counsellors, and in particular we know a lot about UK university fee status rules.
Now, mansion tax. Mansion tax is to be introduced in Wales. What does that mean? For the first time in close to 20 years, they've been reviewing, Welsh Government has been reviewing its tax situation on property designed to make tax fairer, as it calls it. The most radical of the 3 principal reforms on the table proposes increasing the current number of tax bands from 9 to 12, adding 1 new band at the bottom and 2 at the top end for the most expensive properties, over 1.2 million. And the government says this would be a decisive move in the direction of fairness. Around 785 properties, 53%, would see a reduction in their bill of £50 or more, but close to 40,000 of the higher value properties would see an increase of over £1,000, according to IFS, the Institute of Fiscal Studies. Overall, close to 500,000 average bills would rise by 5 to 7% in Cardiff, Gwynedd and the Isle of Anglesey, Pembrokeshire and Powys, the think tank said. Parts of inner city Cardiff and much of Swansea would see falls of £250 to £500 in annual bills under the plans. However, the hardest hit would be suburbs, the more expensive suburbs of Cardiff, Western Swansea, where to see average bills going up by more than £1,500. On top of that, Monmouthshire would have a massive rise, as would the Vale of Glamorgan at 16% and 15%. So that's pretty grim. Is it a good time to buy property now? This week's inflation news indicates a cut in the Bank of England rate by April, which has got to be good news for rates. Rates still, though, at the moment are at 5% plus, but we should see them coming down to 4% a lot quicker. But cost of living crisis is still there, though it is easing. If you look at the Salvo review that came out this week, it's already out of date with these latest figures, so just goes to show what doing these pontifications, how useless it is, my own included. They suggest that the South Coast and South East will take a battering, and it must do. You know, it went up by so much during COVID, 30-40%. It's got to come off by 10%. People aren't living on the coast. Work from home is no longer what it was. So the latest inflation figures, the effect of post-COVID price hikes, now price falls, has got to mean that some areas like the southeast and the southwest will fall in price. But as you can see from the figures, it's much more benign, and I think it will be more benign than they're showing in the Midlands and the north, because it's just a lot more cost effective to do it in those locations. You can work from home, travel in, and things work okay. You can live in Sheffield, work in Manchester. 3 days a week, you can stay in a hotel that's cheap as chips. So work from home is still working up there. And remember, after Canada, we have the second highest work from home ratios in the world. So the bigger picture is it a good time to buy? No, it's not. Is it a bad time to buy? No, it's not. It's never a good time, it's never a bad time. Look at this graph here from Property Data. It goes back to 1977, before the financial crisis, upward trend all along. Look at the graph going back to the ONS, as it was in those days, not the ONS, from 1952 until the present day. It's always going up. Short-term blimps, but not long-term. There's no reason to believe, when you've got the population raising from 62 million 10 years ago to 67.5 million now, that it would be any different. Thank you for watching Market Wrap 179. I hope you enjoyed it. Stuart Williamson here at the helm. Do comment, do leave, whatever thoughts you have. Do subscribe if you wish. It'd be great if you could. Help get our algorithms up there and gets more people to hear about us. Thank you. Cheerio. Bye-bye.